short time ago, the United States military began major combat operations in Iran. Our objective is to defend the American people by eliminating imminent threats from the Iranian regime.
This is one of the worst starts to the year on the stock market in the last decade. The year 2026 began in a way that did not please investors. The S&P 500 index has been down around 2 to 3% since the beginning of the year. The technology-heavy Nasdaq has lost up to 5%, and the volatility remains significantly higher than at the end of the last year. The VIX volatility index has even reached levels that until recently were capable of sending stocks down by as much as 8% in a matter of days. The current declines, while not sounding so dramatic, have resulted in one of the weakest starts to the new year for stocks in the last decade. Perhaps more importantly, the settings of the indices is beginning to resemble the situation at the turn of 2024 and 2025. At that time, after strong growth, the markets lost momentum and moved sideways for several months. A similar scenario is beginning to emerge this year. Could there be a 26% decline as in 2025? The first major factor pushing markets down in 2026, or at least preventing them from growing further, is record investment in AI infrastructure. Hyperscalers and tech giants are planning capex in the tens of hundreds of billions of dollars per year. Amazon has announced investments in AI and data centers of around $200 billion over the next few years. While this is so positive for the entire sector in the long term, in the short term, it puts pressure on cash flow and margins. The market is beginning to take notice. We see this mainly in the case of some technology stocks, which entered the year with very tight valuations after extreme growth in 2023 to 2025. As soon as even the slightest uncertainty about the return of these investments emerged, multiples began to decline rapidly. The second major issue is geopolitics. Tensions in the Middle East have brought back the risk premium, which was almost zero just a few months ago. We know from history that such events increase volatility, support the energy sector, and at the same time, reduce the level of acceptable risk for investors. Capital is thus gradually shifting to energy, defense, and other more defensive segments. Take Walmart, which has already gained 12% since the beginning of the year and is now trading at a record P/E ratio. Stockbot on Bullius will tell you what impact this may have on the share price within seconds. The third factor is the infrastructure of the market itself. The range in which the vast majority of trading sessions have taken place in recent weeks is one of the narrowest we have seen in the last 20 years. This is a typical sign of a market losing short-term momentum. Looking at historical data, a similar environment has often led to several months of consolidation, not necessarily an immediate bear market. And this is where the parallel with the turn of 2024 and 2025 comes back. Indices moved sideways, volatility was elevated, and investors were extremely sensitive to macroeconomic data and corporate outlooks. All this resulted in a sharp decline in prices, which was exacerbated by Donald Trump's introduction of tariffs. The key question for 2026 is therefore, are we seeing just a healthy consolidation after a strong bull run, or the beginning of a deeper slump? History shows that a weak start to the year does not necessarily mean anything. For example, in several cases over the past 20 years, the market has managed to end the year in positive territory. On the other hand, is it fair to say that the current environment is significantly more complex than it was a year ago? Markets are still struggling with higher rates, much higher capex, geopolitical tensions, and relatively tight valuation in parts of the market. The coming weeks will therefore be extremely important. The market will be sensitive to developments in bond yields, which are still above 4%, and other economic events. One thing is certain already, 2026 did not start well for stocks. However, this does not mean that the stocks cannot continue to grow. This video may be ending, but you can already start discovering companies on Bullius that are capable of growing in the current situation. Whether you are looking for defensive or dividend stocks, the Fair Price Index and Bullius provides you with all the tools you need for a thorough analysis of stocks.